Imagine you are chief executive, an investor or creditor. Your company has sent to you the annual report. Today we will sit at the desk, open this company report and calculate the full market ratio dashboard.
Now suppose someone says the share is cheap because its P to E is only 5. Do you trust that answer? Not until every number can be traced to a visible source and the dates match. For each of these 23 measures, we will ask the business question, explain the market purpose, locate the original figures, build the complete math, and read the result through management, investor, and creditor lenses. Keep 5 evidence files open: the income statement, balance sheet, cash flow statement, share note, and market data. Income and cash flow cover a period. Balance sheet amount and the share price belong to a specific date. Earnings per share uses weighted average shares, while market capitalization uses shares outstanding at the valuation date. Enterprise value adds debt and preferred claims, then subtracts cash. Benchmark ranges are practical guides, not universal standards. Compare the industry, historical trend, business risk, and valuation date. We will state the EBITDA and free cash flow definitions used. A ratio is a signal, not a decision. No mystery numbers. A correct formula can still mislead when it uses the wrong date, claim, or financial statement. Before calculating ratios, confirm that the company's reports are logical. Start with the income statement. Revenue is $1 million. After cost of sales, Sunny Pizza earns gross profit of $400,000. Cash operating expenses leave EBITDA of $220,000. After depreciation and amortization, operating profit is $200,000. Interest and tax reduce net income to $120,000. Keep the complete statement visible because different ratios will return to different lines. Now open the balance sheet. Cash is $100,000. Total assets are $900,000. Liabilities are $600,000, including short-term and long-term debt. Preferred equity is $50,000 and common equity is $250,000, producing total equity of $300,000. Liabilities of $600,000 plus equity of $300,000 equal total assets of $900,000. The balance sheet balances. We will use debt, cash, common equity, preferred equity, and intangible assets in later calculations. Next, open the cash flow statement. Operating cash flow is $160,000. Subtract $60,000 of capital expenditure, and simplified free cash flow is $100,000. After financing cash flows, cash increases by $50,000 from an opening balance of $50,000 to closing cash of $100,000, agreeing with the balance sheet. The equity statement also reconciles. Opening equity of $230,000, plus net income of $120,000, minus $20,000 of preferred dividends and $30,000 of common dividends, gives closing equity of $300,000. The share note reports 50,000 basic weighted average shares, 55,000 diluted shares, and 50,000 year-end shares. Finally, market data shows an $8 beginning price, a $10 December 31st closing price, an expected EPS growth of 10%. Historical statements, market prices, and forecasts are different information types. We will label each source and date before using it. How much common profit belongs to one average share? Standardizes common earnings into one comparable share. Start with net income of $120,000 from the income statement. Subtract $20,000 of preferred dividends from changes in equity. Divide the remaining $100,000 by 50,000 basic weighted average shares. Basic EPS is $2. $2 of basic EPS means Sunny Pizza earned $2 for every average common share outstanding during the year. The market uses EPS because total profit alone cannot compare companies with different numbers of shares. Management should separate genuine profit growth from share count changes. Investors should examine the EPS trend, cash conversion, and one-time gains. Creditors treat EPS as a secondary signal. Stronger earnings may support the equity cushion, but debt is repaid with cash or not EPS. Diluted EPS asks what each share could earn if potential shares appear. First, calculate the weighted average number of common shares outstanding, or WANCSO. 50,000 shares were outstanding all year, so 50,000 times 12 over 12 gives 50,000 WANCSO. For this simplified case, assume 5,000 incremental dilutive option shares with no numerator adjustment. Diluted weighted average shares therefore become 55,000. Common earnings are net income of $120,000 less $20,000 preferred dividends, $100,000. 100,000 divided by 55,000 gives diluted EPS of $1.82. This shows the potential reduction in each owner's claim. Convertible debt or preferred shares may also require a numerator adjustment and an anti-dilution test. Management reviews compensation and financing instruments. Investors compare diluted EPS with basic EPS. Creditors examine conversion terms. How much annual dividend belongs to one common share? Converts the total common dividend into a per-share payment. Take common dividends of $30,000 from changes in equity. Divide by 50,000 common shares in this stable share example. Dividend per share is 60 cents. 60 cents of DPS means each common share received 60 cents of declared annual dividend in this simplified example. The market uses DPS to compare shareholder cash distributions on a per-share basis. Management should test whether the dividend fits future investment and financing needs. Investors use DPS to assess income consistency and growth. Creditors watch the same payment because dividends remove cash that could otherwise repay debt or strengthen liquidity. What does the market say all common shares are worth? Measures the market value of the common equity claim. Take the $10 closing price from market data. Multiply by 50,000 year-end common shares from the share note. Market capitalization is $500,000. $500,000 is the market's total value for Sunny Pizza's outstanding common shares at the measurement date. The market uses capitalization to describe equity size, but it is not the value of the entire operating business. Management watches it when considering share issuance, acquisitions, investor communication, or takeover exposure. Investors use it for company size, liquidity, and portfolio classification. Creditors may view market capitalization as a changing equity buffer, but market prices can fall quickly. What is the value of the whole operating business? Combines major capital claims and removes cash. Start with market capitalization of $500,000. Add total debt of $380,000 and preferred equity of $50,000. Subtract $100,000 of cash. Enterprise value is $830,000. Enterprise value combines common market value, debt, and preferred equity, then subtracts cash. The market uses it to compare the value of the operating business across companies with different financing structures. Management uses EV in acquisition, disposal, and capital structure decisions. Investors use it with revenue or EBITDA rather than common earnings. Creditors focus on the debt included in EV and the available cash deduction, but enterprise value is not a guaranteed recovery amount. How much is the market paying for $1 of earnings? Connects the current share price with common earnings. The market price is $10 and basic EPS is $2. 10 divided by 2 gives a P/E ratio of 5 times. A P/E of 5 means the market pays $5 for each dollar of current common earnings. The market uses PEE because it connects share price with profit attributable to common shareholders. Management sees the growth and risk expectations embedded in its share price. Investors compare the multiple with peers, history, growth, and earnings quality. Creditors may treat a falling PE as a market confidence warning, but it does not directly measure debt-paying ability. Before calling 5 times cheap, compare unusual earnings, the business cycle, growth, debt, and peer multiples. If current earnings are temporarily high, the denominator can make P to E look artificially low. If earnings are temporarily depressed, the multiple can look high even before a recovery. P to E is therefore an investigation trigger, not a final buy or sell decision. What percentage of price is represented by earnings? Reverses P, E into a percentage form earnings price relationship. Reverse the P to E fraction. $2 EPS divided by the $10 market price equals a 20% earnings yield. 20% earnings yield is the inverse of a 5 times PT. It expresses common earnings as a percentage of the current share price. The market uses it to make the earnings-price relationship easier to compare in percentage form. Management can observe how earnings performance affects the implied yield. Investors may compare it with alternatives, but it is not a promised cash return. Creditors should not confuse earnings yield with interest coverage or cash available for debt service. How much common equity value is paid for $1 of sales? Provides a valuation reference even when earnings are weak. Divide $500,000 of market capitalization by $1 million of revenue. Price to sales is 0.5 times. A price to sales ratio of 0.5 means common equity is valued at 50 cents for each dollar of annual revenue. The market uses P/S when earnings are small, negative, or difficult to compare. Management should ask whether revenue is converted into acceptable margins and cash. Investors must compare companies with similar economics because revenue without profit can destroy value. Creditors look beyond sales to cash collection, margins, and the costs required to serve that revenue. Is the PE reasonable relative to expected growth? Connect valuation with a stated growth forecast. Take the 5 times P to E and divide by expected EPS growth of 10, using 10 as the whole percentage number. The PEG ratio is 0.5. A PEG of 0.5 compares the 5 times PE with expected EPS growth of 10%. The market uses PEG to connect valuation with growth rather than viewing PE alone. Management should understand the growth required to support expectations. Investors must challenge the forecast period, source, and sustainability. Creditors treat projected growth cautiously because forecasts do not repay debt. A low PEG can reflect value, or simply an unrealistic growth assumption. How much recorded common equity supports one share? Create an accounting equity reference per year-end share. Take common shareholders' equity of $250,000 from the balance sheet. Divide by 50,000 year-end common shares. Book value per share is $5. $5 book value per share means each year-end common share is supported by $5 of recorded common equity. The market uses BVPS as an accounting reference point, especially for asset-heavy businesses. Management should protect asset quality and returns earned on the equity base. Investors compare book value with market price and return on equity. Creditors view common equity as a loss-absorbing layer, but recorded book value is not guaranteed collateral or liquidation cash. What premium does the market place on common book value? Compares market price with recorded common equity per share. Divide the $10 market price by $5 book value per share. Price to book is 2 times. Price to book of 2 means the market pays $2 for each dollar of recorded common equity. The market uses it to judge the premium or discount placed on the accounting equity base. Management should ask whether profitability and growth justify that premium. Investors connect PB with return on equity, asset quality, and comparable companies. Creditors may see a high market premium as confidence, but lending protection depends on real asset values and claim priority. What recorded common equity remains after intangibles? Provides a more conservative tangible equity reference. Subtract $50,000 of goodwill and intangibles from common equity of $250,000. Divide the remaining $200,000 by 50,000 shares. Tangible book value per share is $4. $4 tangible book value per share removes recorded goodwill and other intangible assets from common equity. The market uses it when analysts want a more conservative view of recorded tangible support. Management should understand how acquisitions and goodwill affect the balance sheet. Investors often emphasize TBVPS for financial institutions and asset-based businesses. Creditors may prefer tangible support, but not every tangible asset is liquid, unencumbered, or worth its carrying amount. What does the market pay for $1 of tangible book value? Applies a stricter market premium to tangible common equity. Divide the $10 market price by $4 tangible book value per share. Price to tangible book is 2.5 times. Price to tangible book of 2.5 means the market pays $2.50 for each dollar of recorded tangible common equity. The market uses this stricter book multiple when goodwill or intangibles are significant. Management should assess whether returns justify the premium over tangible capital. Investors compare the result with peers and tangible return on equity. Creditors should still perform collateral analysis because a market multiple does not establish recoverable asset value. Before calculating the free cash flow multiples, build the cash bridge visibly. Operating cash flow is $160,000. Capital expenditure is $60,000. Subtract capital expenditure from operating cash flow, leaving simplified free cash flow of $100,000. This is not a universal accounting subtotal, so the company's definition must always be shown. The central question is whether the capital expenditure deduction is sufficient to maintain the business. Separate maintenance spending from expansion where reliable information exists, and check whether working capital timing temporarily lifted operating cash flow. Only then should free cash flow move into a valuation multiple or yield. How much common equity value is paid for operating cash flow? Cross-checks valuation against cash generated by operations. Divide market capitalization of $500,000 by operating cash flow of $160,000. Price to operating cash flow is 3.13 times. 3.13 times operating cash flow means common equity is valued at just over 3 times the annual cash generated from operations. The market uses PE/OCF to compare price with cash generation and to cross-check accounting earnings. Management should examine working capital discipline. Investors should test whether operating cash flow is recurring or temporarily boosted. Creditors focus on the same cash source, but must deduct capital expenditure, taxes, and other required payments before judging debt capacity. Price to free cash flow asks how much common equity value is paid for free cash flow. For this lesson, free cash flow equals operating cash flow of $160,000 minus capital expenditure of $60,000, giving $100,000. Market capitalization is $10 times 50,000 year-end shares, or 500,000. 500,000 divided by 100,000 gives a price to free cash flow ratio of 5 times. Free cash flow is not a standardized accounting subtotal, so always verify the definition, maintenance capital expenditure, growth investment, and working capital timing. Management explains how free cash will be allocated. Investors test whether it is repeatable. Creditors preserve cash needed for maturities and required investment. What percentage of market value is represented by free cash flow? Reverses P or FCF into a percentage form cash flow relationship. Reverse the price to free cash flow fraction. $100,000 of free cash flow divided by $500,000 of market capitalization equals 20%. 20% free cash flow yield means annual simplified free cash flow equals 20% of current common market value. The market uses the yield as the percentage form inverse of P or FCF. Management can see whether cash generation supports valuation and capital allocation. Investors may view a high yield as attractive, but it can also signal expected decline. Creditors should analyze whether the cash is sustainable and genuinely available after mandatory claims. How much common profit is distributed? Shows the share of common earnings paid as dividends. Common dividends are $30,000 and common earnings are $100,000. 30,000 divided by 100,000 gives a 30% payout ratio. A 30% payout means Sunny Pizza distributes 30 cents from each dollar of common earnings. The market uses payout to judge dividend policy and how much profit remains for growth. Management balances shareholder income with reinvestment, liquidity, and debt reduction. Investors assess dividend sustainability and business maturity. Creditors monitor payout because excessive distributions can weaken liquidity and creditor protection, particularly when earnings are not converting into cash. How much common profit remains in the business? Shows the share of earnings retained for growth and resilience. Retention is the portion not paid out. 100% minus the 30% payout gives a 70% retention ratio. A 70% retention ratio means Sunny Pizza keeps 70 cents from each dollar of common earnings. The market uses retention to estimate the portion available for internal growth and balance sheet strengthening. Management must earn an acceptable return on retained profit. Investors should not assume retention automatically creates value. Poor reinvestment can destroy it. Creditors may welcome a larger retained cushion, but only if the retained earnings produce cash and are not absorbed by losses. What dividend income rate is offered by today's price? Compares annual dividend per share with the current market price. Dividend per share is 60 cents and the current market price is $10. 60 cents divided by $10 gives a 6% dividend yield. A 6% dividend yield means the current annual dividend per share equals 6% of the $10 market price. The market uses yield to compare current dividend income with the price paid. Management observes the income signal but should not defend an unsustainable dividend. Investors must distinguish a healthy yield from a yield raised by a collapsing share price. Creditors examine whether dividend cash outflows compete with interest, principal, and investment needs. How many times do earnings cover the dividend per share? Measures accounting earnings support for the current dividend. Basic EPS is $2 and dividend per share is 60 cents. 2 divided by 0.6 gives dividend coverage of 3.33 times. Dividend coverage of 3.33 means EPS is more than 3 times DPS. The market uses coverage to see how much accounting earnings support the dividend. Management can evaluate room for stability or growth in distributions. Investors generally prefer sustainable coverage rather than the highest possible yield. Creditors may see stronger coverage as helpful, but cash flow coverage remains more important because EPS can include non-cash estimates and unusual gains. What whole business value is paid for $1 of revenue? Compares operating business value across financing structures. Enterprise value is $830,000 and revenue is $1 million. EV to sales is 0.83 times. EV to sales of 0.83 means the operating business is valued at 83 cents for each dollar of revenue. The market uses EV sales to compare whole business value across different financing structures, including companies with weak earnings. Management should focus on revenue quality and the margins created from it. Investors must compare similar industries and business models. Creditors examine whether revenue becomes cash and whether operating margins can support total debt. EV to sales becomes especially useful when profit is thin, volatile, or temporarily negative, because revenue remains visible. But two companies with the same sales multiple can deserve very different values. The company with stronger gross margin, recurring revenue, pricing power, and cash conversion can support the higher multiple. For Sunny Pizza, connect 0.83 times sales with a 22% EBITDA margin. What whole business value is paid for operating EBITDA? Compares enterprise value with pre-interest, tax, depreciation, and amortization earnings. For this lesson, EBITDA equals EBIT of 200,000 plus depreciation and amortization of 20,000, giving $220,000. Divide enterprise value of 830,000 by that EBITDA. EV to EBITDA is approximately 3.77 times. EV to EBITDA of 3.77 means the whole operating business is valued at almost 4 times annual EBITDA. The market uses this multiple to compare companies with different debt and tax structures and to evaluate acquisition pricing. Management sees how operating performance influences enterprise value. Investors compare peers and normalized EBITDA. Creditors use EBITDA as one starting point for debt analysis, but EBITDA is not cash flow and ignores capital expenditure and working capital. EV to EBITDA can improve comparison across financing structures, but EBITDA is not cash flow. After reading 3.77 times, bridge it to operating cash flow, capital expenditure, leases, interest, and debt service. Compare normalized EBITDA with peers and verify every adjustment. What complete return did a shareholder receive this year? Combines price appreciation and dividends over a stated period. The price increased from $8 to $10, creating a $2 gain. Add 60 cents of dividend per share. Divide $2.60 by the $8 beginning price. Total shareholder return is 32.5%. 32.5% total shareholder return combines the increase from the $8 beginning price to the $10 ending price with the 60-cent dividend. The market uses TSR to evaluate the shareholder's complete historical return over a stated period. Management may use it to assess value delivery relative to peers. Investors separate price gain from dividend income. Creditors treat TSR as a market confidence indicator only. Strong historical returns do not prove future repayment capacity. Now step back and read the complete dashboard. Per share results are $2 basic EPS, $1.82 diluted EPS, and 60 cents dividend per share. Market capitalization is $500,000, while enterprise value is $830,000. The price and growth family contains 5 times P to E, 20% earnings yield, 0.5 price to sales, and 0.5 PEG. Book measures are $5 book value, 2 times price to book, $4 tangible book value, and 2.5 price to tangible book. Cash measures are 3.13 price to operating cash flow, 5 times price to free cash flow, and 20% free cash flow yield. Dividend measures are 30% payout, 70% retention, 6% yield, and 3.33 coverage. Enterprise measures are 0.83 EV to sales and 3.77 EV to EBITDA. Total shareholder return is 32.5%. The chief executive sees dilution, expectations, capital allocation, and financing choices. The investor sees earnings, cash, assets, growth, and return. The creditor sees debt claims, market confidence, and cash support. No single card gives a verdict. Benchmark ranges are guides, not universal standards. Compare trends, peers, risk, valuation dates, and cash quality. A ratio is a signal, not a decision. For every change, explain because, then act with therefore. A ratio is a signal, not a decision by itself. When financial reports reach your desk, reconcile them, mark every date, trace every input, calculate in logical families, compare trends and peers, explain the change, and write the action. Open the report. Trace the number. Calculate the ratio. Understand the story. Then lead with the decision.